So you know what a stock is. You understand that buying a tiny piece of a great company is one of the best ways to build wealth over time. But now, you're staring at the stock market and you have a massive problem. Which one do you buy? There are thousands of companies out there. If you pick the wrong one, you could lose your hard-earned money. If you try to pick the right one, you have to spend hours reading financial reports, checking stock prices, and stressing over the news. It is stressful, it is risky, and frankly, it is exhausting. This is what we call analysis paralysis. But what if I told you that you don't have to pick the winner? What if instead of trying to find the needle in the haystack, you could just buy the whole haystack? Welcome to the world of the ETF. This is Index Compass. Today we are answering the question, what is an ETF and why is it the secret weapon for building wealth without the stress? First, let's strip away the financial jargon. ETF stands for Exchange Traded Fund. That sounds boring and technical, but stick with me because understanding these three words will change your financial future. Let's start with the last word first, fund. Imagine you and 1,000 other people all put your money into a big pile. That massive pile of money is the fund. A professional manager then takes that huge pile of cash and uses it to buy stocks for you. Instead of you going out and buying one share of Apple, one share of Amazon, and one share of Tesla separately, the fund buys them all at once. Now for the exchange-traded part. Usually joining a specialized investment fund is difficult. It used to be only for the rich, but an ETF is special. It trades on the stock exchange exactly like a normal stock. This means you can buy or sell a slice of this massive basket instantly with one click on your phone, just like you would buy a single share of a regular company. You get the benefits of a massive fund with the speed and simplicity of a regular stock. Let's look at the most famous example in the world to make this concrete, the S&P 500 ETF. In the United States, there are 500 gigantic companies that basically run the economy. You know their names: Apple, Microsoft, Amazon, Google, Coca-Cola. To buy one single share of each of those 500 companies individually, you would need tens of thousands of dollars. It would be a nightmare to manage. You would have to pay hundreds of separate transaction fees. But if you buy one single share of an S&P 500 ETF, like the ones with ticker symbols VOO or SPY, you instantly own a tiny piece of all 500 companies at the exact same time. One transaction, one price, 500 companies. Why is this better than just picking stocks yourself? The first major reason is diversification. It is the old saying, don't put all your eggs in one basket. If you put all your money into one single company, and that company goes bankrupt or has a bad year, you could lose a significant amount of your savings. But in an ETF, if one company fails, it is just a tiny speck in your basket. The other 499 companies keep you safe and keep your money growing. Now, I want to be 100% honest with you. This does not mean you can't lose money. If the entire stock market crashes, your ETF will go down too. But here's the difference. A single company can go bankrupt and go to zero. But the entire economy of the United States is not going to go to zero. The ETF will survive, and historically, it always bounces back. The second reason is something beginners often miss, and it is my favorite part. ETFs are self-cleansing. In the S&P 500, if a company starts doing a terrible job and loses value, it gets kicked out of the list. It is automatically replaced by a new, growing company that is performing better. You don't have to do anything. You don't have to read the news. You don't have to sell the bad stock. The ETF automatically gets rid of the losers and adds the winners for you. It is like having a garden that weeds itself, and it is not just for the top 500 companies. There is an ETF for almost everything. Do you believe in the future of technology? You can buy a tech ETF that holds a basket of computer chip companies. Do you want to invest in companies outside of America? You can buy an international ETF that holds companies from Europe or Asia. You can even buy ETFs that track the price of gold or real estate. So what is the catch? Because there is a company managing this basket for you, they charge a small fee. This is called the expense ratio. In the old days of mutual funds, bankers would charge you 1% or 2% of your money every single year just to manage it. That sounds small, but over 30 years, a 2% fee could cost you hundreds of thousands of dollars in lost profit. The good news, for the big popular ETFs we are talking about today, this fee is tiny, usually around 0.03%. That means for every $10,000 you invest, they only take about $3 a year. It is basically free. You get professional management, diversification, and safety, all for the price of a cup of coffee. So to recap, an ETF is a basket of stocks that you can buy as easily as a single share. It lowers your risk, it diversifies your money instantly, and it costs almost nothing to hold. It is the smartest way for most people to build long-term wealth without the stress of analyzing individual companies. But wait, once you own this basket, how do you actually make money from it? Do you just wait for the price to go up, or do they pay you cash? In the next video, we are going to talk about the magic of dividends and the most powerful force in finance, compound interest. Hit that subscribe button so you don't miss it. Thanks for watching.